Goods and Services Tax, GST. First, let us look at the learning objectives for the session today. 1. Scope of Goods and Services Tax, GST. Explain the requirements for a GST registered business and how GST is accounted for and administered. Describe the scope of GST, including transactions which are out of scope, for example, third country sale and transfer of going concern. Next, identify and explain the different type of supplies, for example, standard rated, zero rated, and exempt supplies. Last but not least, explain the GST implications of imports and exports. So, what is GST? GST is Singapore's version of Goods and Services Tax. Goods and Services Tax is basically a form of indirect tax imposed on consumption of goods and services within a country. Generally, it is also collected at the borders when goods enter into a country. For those of you who do not reside in Singapore, you may also have encountered the indirect tax regime in one form or another in your country. For example, for those of you who are residing in Vietnam, you will be familiar with the Vietnamese VAT, value added tax. The same name has been used in Thailand and Indonesia. Nearby, Malaysia also has its own version of indirect tax known as Sales and Services Tax, commonly known as SST. So, indirect tax should not be new to the APAC region, and today our focus will be to understand Singapore's version of indirect tax, commonly known as Goods and Services Tax in Singapore. GST is a broad-based tax imposed on consumption of goods and services as well as importation of goods into Singapore. From a financial perspective, the burden of GST is borne by the final consumer, namely you and me. GST works under a self-assessment system. Therefore, the onus of determining tax liability rests on the taxable person making the supply. As an individual who resides in Singapore, GST can be said to be part of my everyday life. For instance, going out to the restaurant for dinner, or simply purchasing a laptop at one of the departmental stores, you are more likely than not looking at a 9% GST being imposed on those purchases. Therefore, what is clear is that GST is a form of tax that is ultimately financially borne by the consumers, such as you and I. Next, we'll move on to look at who are the parties in the supply chain in relation to GST. So on the left, we have consumers, moving on to seller, and to the Inland Revenue Authority of Singapore, commonly known as IRAS, as well as the government. Consumers like you and I are being charged GST by the seller when we purchase goods and services. Therefore, we will need to pay the GST as charged to the seller. In this case, the seller of the goods and services is acting as a GST collecting agent for the government. And the GST that they collect will be considered as their output tax to be reported in their GST return. The role of IRS is to administer the tax legislation, including the GST Act. They also are the responsible party to review the GST return filed by the seller and to collect GST from the seller. Last but not least, the government, rather the Singapore government, is the proper owner of all the GST collected by the IRS. How is GST accounted for? As a GST registered business, one must submit the GST return to the IRS 1 month after the end of each prescribed accounting period. This is usually done on a quarterly basis. For example, a company whose financial year end is 1st Jan to December 31st would likely see the first period of its GST return to cover from 1st Jan of the year to 31st March of the year. The quarter 1 return will be due for filing to the Inland Revenue within 1 month from the end of the quarter, which means it will be due by 30th April. Generally, the taxpayer or the business is required to file the GST return and make payment for the GST at the same time. So what are the key concepts under the GST Act? To understand that, we will look at Section 8.1 of the GST Act. GST is chargeable when all the following conditions are met. A. Constitute a supply of goods or services. B. The place of supply is made in Singapore. C. Type of supply is a taxable supply. D. Made by a taxable person in the course or furtherance of any business carried on by them. While these may appear to be very daunting jargons at the start, hopefully by the end of today's session, you will be familiar with all these concepts, which will make up the basic of GST determination. Essentially, what is a supply? The supply of goods and services can be defined under Section 10(2) of the Goods and Services Tax Act. In general, a supply of goods and services refers to anything done in return for a consideration. Therefore, a supply exists if the following elements are present. One, there is a consideration, maybe in monetary terms, such as cash or in kind, and the consideration is in exchange for something done. So how do we understand the concept in a real life situation? In the first very basic example, if I walk into a coffee place, order a cup of black coffee, and pay cash or credit card for it, essentially the act of me purchasing the coffee constitutes a taxable supply. This is because I have provided monetary consideration in terms of my payment to the coffee place in exchange for the coffee. Now, this is the most simple understanding of what is a supply. However, you will need to address other more complex type of supply in the coming slides, such as deemed supply. We will cover that in due course. For now, you should bear in mind that whenever you see a transaction involving a consideration in exchange for another matter, such as goods or services, it is likely to form a supply. An example of what is not a supply would be in a situation where you place a refundable deposit. One good example will be when we check into the hotel may request for you to place a deposit, such as security deposit, which generally would be enough to cover the cost of your stay. If the amount is refundable to you subsequently, then the timing that you pay for the security deposit should not be constituting a supply, and therefore GST is not applicable. Next, deemed supplies would be a situation that does not require any consideration. Deemed supply can be found under the second schedule of the GST Act. Examples of a deemed supply includes gifts that are more than 200 Singapore dollars in value provided in the course of furtherance of a business, or non-business and private use of business assets. The main difference between an actual supply or a deemed supply is that under a deemed supply situation, there is no need to establish the existence of a consideration. Meaning, you might feel that it is a one-way ticket rather than two-way, because in the usual supply, when we provide, let's say, a coffee, you are expected to make payment. However, in the deemed supply situation, it's usually one way, such as gifts to employees, gifts to a business associate. That could constitute a deemed supply under the second schedule of the GST Act. Next, what are the types of supply? First, we will look at taxable supply. Under the taxable supply category, there are two main types of supplies, namely standard rated supplies and zero rated supplies. All goods and services that are made in Singapore will be considered as standard rated supplies that are subjected to the prevailing GST rate. Today, the prevailing GST rate in Singapore is 9%. Zero rated supplies refers to supplies that are exported out of Singapore and generally include exports of goods and international services, and the applicable GST rate is 0%. Next, we move on to non-taxable supply. Non-taxable supply generally could refer to exempt supplies. The list of exempt supplies can be found in the fourth schedule of the GST Act. Some examples of exempt supplies include sale and lease of residential properties and select financial services. Take note that the exempt supplies definition only covers the sale and lease of residential properties. For the sale and lease of commercial properties, it would constitute no taxable supply. The next category of a non-taxable supply, or could also be known as not a supply, refers to out-of-scope supply. Out-of-scope supplies refers to transactions that are out of scope of the GST. One very common example would be third country sales of goods. In short, shipment of goods that do not arrive or bypass Singapore physically. For example, a Singapore company may have sold goods to a US customer. However, because the Singapore companies manufacture those goods in China, they physically ship the goods from China to the US. Hence, instead of treating them as zero-rated supplies where the goods are exported, we should regard this as out-of-scope supply where the goods did not at any time physically enter or leave Singapore. This would be a classic example of a third country sales. Next, we'll move on to understand better what are the determination rules with respect to provision of goods and services between the different type of supplies. Here you can see that there are 4 parties involved in a transaction. Here, A and D are parties located in Singapore, where B and C are parties located outside of Singapore. Starting from A, when A sells the goods to B and deliver to B outside of Singapore, A should treat this as a zero-rated transaction. When B transacts with C, with both parties outside of Singapore and the goods not entering Singapore at any point of time, it will be treated as out of scope for GST purposes. On the next leg, C sold the goods to D, and D is based in Singapore. Therefore, the goods physically entered Singapore from outside of Singapore. In this case, D will be required to pay GST at the borders administered by Singapore Customs in order for the goods to enter Singapore, and this will be considered a standard rated transactions. And lastly, when D sells to A, the goods is being sold to another customer in Singapore and physically moved to another location in Singapore, considered as made in Singapore, and also a form of standard rated supply. So, a summary on place of supply for goods. The most important 2 aspects we need to understand is the starting location and the ending location. Using the earlier examples, putting in real life countries, if the starting location is in Singapore and the ending location is in Singapore, the place of supply would then be considered to be in Singapore, and with the supply being made in Singapore, standard rated GST of 9% is applicable. In the second row, we have a situation where the physical goods starting location is in Singapore and the ending location of the goods is in Japan outside of Singapore. Even though the supply is considered to be made in Singapore, because the ending location is in Japan, is considered to be an export of goods from Singapore, therefore zero rated supply, 0% GST is applicable. In the third situation, we have the goods being physically outside of Singapore in Thailand, and the ending location of the goods is in Japan, another location outside of Singapore. In this case, the supply is made outside of Singapore, and given that the goods did not physically enter Singapore at any point of time, we consider them to be third country sales and therefore be classified as out of scope supply for GST purposes. Next, we'll move on to provision of services. For services, if the place of supply in Singapore, it is standard rated unless we can consider it to be an international services under Section 21(3) of the GST Act. For zero-rated supplies, there are several different categories. For export of goods, they are both direct and indirect. For international services, as mentioned earlier, the most common export category is Section 21(3)(j) of the GST Act. For 21(3)(j), in order to zero rate a supply of services, it must be under a contract with a person who belongs in a country outside of Singapore and which directly benefit the person belonging in a country other than Singapore and is outside of Singapore at the time the services are performed, or a registered person who belongs to Singapore. Exempt supplies. These can be found in the 4th schedule to the GST Act, which specifically contain a list of supplies that's exempt from GST purposes. Some of the examples include provision of select financial services, sale and lease of residential properties, importation and local supply of investment precious metals. For furnished lease rental, the annual value is used to compute the standard rated supply for non-residential properties. In terms of exempt supplies, GST will not need to be charged by the supplier at all. What are some of the common examples of financial services which are considered exempt supply? First, interest income from current or fixed account placed with a Singapore financial institution. This means that for individuals like myself, should I maintain a bank account with DBS or OCBC, a bank in Singapore, the interest income that I earn from my deposits will not be subject to GST on the basis that this is a form of exempt supply. Next, realized exchange gain and losses arising from transacting in foreign currencies. Provision of loan, advance, or credit to employees. However, one thing to note is if the exempt supplies are supplied to a person who belongs outside of Singapore, these supplies will be considered as qualifying for zero rating purposes. Next, we would like to further understand the concept of deemed supply. Deemed supply can be specifically found in the second schedule of the GST Act. The second schedule clarifies and deems certain type of transaction as supply of goods or services. If you recall, we have earlier discussed that for a supply to be established, there is a need to identify an element of consideration. The idea of deemed supply is such that these are supply that exist even though there is no element of consideration. For example, in case of giving a gift to a third party, if you bought the gift in the course of business from a GST registered person, it will not be considered a deemed supply if the gift you are giving to the counterparty is not more than Singapore dollars 200. However, if the value of the gift is more than Singapore dollar 200, it will constitute a deemed supply for which you will need to account for GST. One very important area that I would like to highlight here is that for deemed supply, you are required to account for GST in your GST return. It does not mean that you need to really collect the GST from the person you are giving the gift to. Given that it's a gift, there is no monetary transaction. It is more common for companies to bear the GST cost by paying the GST to the Singapore Inland Revenue Authority out of its own pocket. Now, one other point to note is if you buy the gift in the course of business, but from a non-GST registered person, the gift to a third party is not a supply, as no input tax was incurred. Right, now with that, we move on to the next segment on GST registration requirements. Let's go through the learning objectives. 1. Describe what are the circumstances and implications for an entity to register for GST. Explain the circumstances in which pre-incorporation and pre-registration input GST can be recovered. Outline the GST implication of group registration and divisional registration. Explain how and when a taxpayer can deregister for GST and the GST implications upon deregistration. Lastly, recognize the GST implications when there is a change in business constitution and ownership. First of all, we have to understand retrospective determination. Retrospective determination means trying to determine your GST liability based on the past transactions. So taxable turnover will be computed on a calendar year basis, typically for the purpose of determining registration liability. There is a need for business to monitor at the end of every calendar year and register for GST if your annual taxable turnover exceeds Singapore dollars 1 million. In the table below, in the event that you have determined that your taxable turnover exceeds Singapore 1 million for the period of 1st January to 31st December of 2024, your due date to apply for GST registration will be within a month of that determination, which is by 30th January 2025. And once registered, the effective date of your registration will be within 1 month, which is 1st March 2025. There, in addition to retrospective determination, you could also have prospective determination of your taxable supply. One must register for GST if there are reasonable grounds to believe that your taxable turnover in the next 12 months will be more than Singapore dollars 1 million. Typically, this is a situation that you enter into a sales contract or business agreement for the next year that has a value of more than Singapore dollars 1 million. Similarly, the registration has to be done within 30 days from the date on which you made a forecast that your taxable turnover for the next 12 months will be more than 1 million Singapore dollars. For example, if the date of forecast is 15 June, you are required to inform the controller of GST and complete registration within 1 month, and that is by 15 July. When a registration is not needed, despite the compulsory registration requirements, if the person is certain that the taxable turnover for the next 12 months will not exceed 1 million Sing dollars due to their circumstances, he will not be liable for GST registration. This is provided if the taxable business can maintain documentary evidence to prove that the specified circumstances have occurred and detailed basis on how he came to the conclusion that his projected taxable turnover for the next 12 months will be 1 million Singapore dollars or less. What is a taxable turnover? Broadly, taxable turnover refers to your revenue that you would derive from operating your business and take into consideration all standard rated and zero rated supplies. However, it excludes exempt supply, out of scope supply, or any sale of capital assets, such as sale of equipment or any plant and machinery. Registration not needed. You can apply to the Comptroller of GST from exemption from registration if you make or intend to make wholly or mainly zero-rated supplies, even when your taxable turnover exceeds 1 million. So what is the definition of wholly and mainly zero-rated supplies? This is when the company's proportion of zero-rated supplies over taxable supplies exceeds 90% and would have been in a net refund position anyway had it been registered for GST. We have talked about the basis of GST registration. When is it compulsory? Under the Singapore GST rules, there are also situations where a company can voluntarily do its GST registration. This can happen even if the taxable supply is projected to be 1 million Singapore dollar or less in the next calendar 12 months and also past 12 months. However, there are some conditions that one have to satisfy in order to do voluntary GST registration. For voluntary GST registration, the company director, the sole proprietor, the partner, or trustee must complete 2 GST e-learning courses available on the IRAS website. It would be exempted if the company director, sole proprietor, or partner has the experience of managing other GST registered business, or if the company engages a person who is an accredited tax advisor or accredited tax practitioner to prepare their GST return, and that person has completed both e-learning courses within the last 2 years. The other requirements for voluntary registration includes the person must remain registered for at least 2 years. Meaning once you have been approved for GST registration, you're not allowed to deregister yourself for the next 2 years. In addition, the business must use GIRO for GST payment or refund, must certify that they will comply fully with the responsibilities of a GST registered business, and make taxable supplies within 2 years if it has not started making taxable supply at the point of applying for GST registration. In addition to the standard conditions above, the controller may also impose other conditions for the GST registration and will not hesitate to cancel GST registration of the business if the business failed to comply with any of the prescribed conditions. Now, we can also look at some other type of GST registration, namely group registration, where GST transactions of a group are be accounted under a single GST return. This means that all the members are jointly and severally liable for any tax due. A single GST group registration number must be quoted by all members on the tax invoices. This is usually applied to a situation where there are a group of Singapore companies, all to be registered for GST purposes. Instead of registering them individually, getting multiple registrations and returns, they could perform a group registration where one GST registration number and return is issued. On the flip side, we do have divisional GST registration, where the IRAS allows independent divisions within a company to secure different GST IDs and report GST separately. For divisional registration, it will not alter the liability or entity that's responsible to pay to the IRAS, meaning that if one of the division does not pay IRAS on a timely basis, the company would still be liable. The 1 million turnover registration limit also apply to the company itself and is not applied separately to each registered division. Exemption from GST registration, as mentioned, for companies making taxable supply who are wholly or mainly zero rated, they could apply to the Inland Revenue to seek exemption from GST registration. Claiming pre-registration GST incurred on goods. A company can claim the input tax in full if the goods are acquired within 6 months before the GST registration and are still held by the person at the time of GST registration. If the goods are acquired more than 6 months before the GST registration and the goods have not been consumed or supplied by the person before the GST registration. For pre-registration, GST incurred on property, rental, utilities, and services, input tax can be claimed in full if the property, rental, utilities, and services are supplied to the person within 6 months before the GST registration and are not directly attributable to supplies made by the person before the GST registration. Next, we'll look at the learning outcome for the computation of GST liabilities. In the next few slides, you would recognize the tax point under the time of supply rules where goods and services are supplied, apply the principles regarding the valuation of supplies, including imports, recognize the circumstances in which input GST is claimable and non-claimable, such as block input tax, explain the GST implications of partial exemption for partially exempt business, including the de minimis rule, compute the available GST relief, recognize the GST treatment for fringe benefit and for reimbursements and disbursements. Claiming GST. The generally rule to conditions to claim GST requires it to be incurred in the furtherance of your taxable supply and not block GST under Regulation 26 or 27. And if all are satisfied, you can move on to claim your GST. You would also need to establish if your GST are considered to be associated with a reimbursement or disbursement. So this has to be understood within the concept of the expenses being incurred. If you are incurring the expense in your capacity as the principal, the recovery of that expense is considered a reimbursement. However, if you are incurring the expense in your capacity as an agent, then the recovery of that expense is called disbursement. So there is a different GST treatment in terms of reimbursement and disbursement. For a principal, a reimbursement constitutes recovery of expense from another party that may be considered a supply and be subject to the GST as the case may prescribe. For an agent, the recovery of expense does not constitute a supply, and therefore GST will not need to be considered. As for the input tax claim, you are entitled to claim the input tax subject to Regulations 26 and 27 incurred on the goods and services you procured in your capacity as the principal if the subsequent recovery of such expense constitute a taxable supply, and that is with effect from 31st May 2013. However, in the capacity of an agent, you are not entitled to any input tax claim on the expenses you incur, as the goods or services are not supplied to you, but to your principal instead. We'll now look at the place of supply. Place of supply is determined by Section 15.3 of the Goods and Services Tax Act. The supplier of services shall be treated as belonging in a country based on the following criteria. 1. The supplier has an establishment in the country and no such establishment elsewhere. 2. The supplier has no such establishment in any country, but its usual place of residence is in the country. 3. The supplier has such establishments both in that country and somewhere else, and the establishment which is most directly connected with the supplier is in that country. The importance of determining whether the supplier of service will belong in a country is important from a GST perspective. This is because it will directly impact your determination of the place of supply. Now, let's look at some practical example to understand the place of supply concept. If you walk into a McDonald's in Singapore, it will be established that McDonald's Singapore has an establishment in Singapore, and of course, there are such establishments elsewhere. But because of the fact that it's established in Singapore and most directly concerned with the supply that's being made, which is to you, because you are walking into McDonald's Singapore to purchase a McDonald's meal. In this case itself, McDonald's Singapore would be determined to have made the supply in Singapore, and the place of supply would be Singapore. This is true for most cases, especially as you read about examples where it involves a retail store in Singapore. The line is blurred when we talk about digital goods and services, and therefore, when you encounter situations involving intangible such as services delivered across the internet, you have to apply these three rules very, very carefully in order to determine if the supply of such intangible services would be deemed to have taken place by a supplier belonging to Singapore. The implications would of course be clear. If the supplier of the service does not belong to Singapore, there will not be any Singapore GST obligations with respect to that supply being made to you.